All right, we are live. It's been a little while since I've done this. I don't know if I got way too much light here. I don't know. I've got a webcam. It just seems like that's really bright. So let me turn on the overheads. Hold on. Ooh, and that flushed it with a bunch of light. All right. It's been a little while since I've done a live stream, so hopefully that'll work just fine. Get rid of this light here. I don't know if we need it. Okay, so I thought I had a little time tonight, so I thought I would jump on and just do a live stream tonight. So let's find some mortgage questions, shall we? If you have any questions, you can throw them in the chat. Okay, let's find some questions. My name is Ryan. I am a mortgage lender. I've been doing home loans since 1999 in the states of Utah and Nevada is where I'm licensed. We do have loan officers within the company that can do other states, but that's where I spend the majority of my time. I'm in southern Utah, but I do lending throughout Utah and Nevada. So now let's find some questions. Hope everybody can hear me. Hope this is working. Jump in the chat if you have any questions. We'll jump to those questions. Let's find a good one. Okay, so here's a good question. What are the consequences if someone cannot afford the down payment on an FHA loan? Can they cancel the deal and walk away from the obligation? So, when you buy a home or when you go under contract, you will have some earnest money that is to secure that contract. And so, you could risk the earnest money deposit that you've done unless you cancel before the deadlines. So, be very aware when you're going through a real estate contract what those deadlines are. And as soon as you pass those deadlines, then you risk that earnest money. But if you cancel after that time, that's where the earnest money can be at risk. Now, there is programs that use FHA for 96.5% of the purchase price. Then you can use down payment assistance programs to cover the down payment, cover that difference. So FHA is really good at either community seconds or down payment assistance programs. So you may not have to even come up with a 3.5% down, depending on your situation. But can you cancel the deal? Yes, but you may be at risk of losing that earnest money deposit if you have passed the deadlines of that earnest money deposit. Now, some states don't have those. You can get refund all the way up to settlement deadline. But here in Utah, we do have a due diligence deadline. This is for home inspections, walkthroughs, checking out insurance rates on like homeowners insurance, getting the title report, just kind of a due diligence on the property. Then you have the financing and appraisal deadline. Then you have settlement deadline. But once you pass those deadlines, you can't use as an excuse to back out of the contract. So that's the biggest thing you have at risk is losing out on that earnest money. But they can't force you to buy the home if you don't qualify, but you do run the risk of breaching that contract. Let's see what else we got here. Can you do a refinance and add a new co-owner through an FHA loan? Yes, depending on if they're occupying the property or not, and depending on the qualifications, and depending on why you need to do an FHA versus doing a conventional loan. So there'd be a couple things I would look at there. There needs a little more details on it, but the short answer would be yes. But there is some moving parts with that. What's the process of painting houses? Why is that in this section? What is the process of painting a house? Well, yeah, I mean, painting a house. I wonder why that's in this section. Oh, can you explain the difference between a mortgage broker and an independent loan officer? Boy, it's funny how our terminology can be very different. I'm very used to some of these terms, so I don't really think I wouldn't connect those two. But a mortgage broker typically is a broker or even a loan officer that has many different sources to actually fund the loan. So they're not funding the loan in the name of their company, they're directing it directly to the funding source. Now, a mortgage broker is going to have access to way more products than just a direct bank or a direct lender in many cases, because lenders like to specialize in certain programs. They don't want to do every single type of loan. They're going to kind of cater towards their investors or a credit union or a bank or a Wall Street hedge fund or DSCR loans or non-QM. So that's why there's so many different lenders. They just have different ways of getting access to funds or different investors to fund their loans. And they'll have different risk tolerances. Not every lender is going to want to do FHA loans or VA loans or non-QM or certain credit scores or less money down. So all these lenders are trying to fit niches and trying to fit in the market. A mortgage broker is going to have access to more of those products because then they can find out, okay, what's the lender need or what's the borrower need and which lender will do that type of loan. Where an independent loan officer is really the one is facilitating that arrangement with those other brokers. So really you're going to have a mortgage broker and a mortgage lender or a mortgage bank that is really the difference of who is actually funding the loan at the closing table. Is it funded in the name of the company that you work for and then the servicing can get sold or it can get changed after that? But who's doing that initial origination, that initial wiring and funding of the loan? Is it directly the company that you're working with, the loan officer's company that you're working with, or is it brokered to another party? And there's really benefits and disadvantages with both product base, product knowledge. What even loan officers gravitate towards certain loans. Like some do reverse mortgages, some do home equity lines of credit, some do only FHA, VA conventional loans, some do non-subprime or non-QM or subprime type loans or construction loans, or there's so many ones out there that you'll see that loan officers even kind of gravitate based on their client base, the loans they like to do. There is just a lot of niches. So, like for instance, I don't really do reverse mortgages, but I have some really good referral sources of loan officer. I know that that's what they really gravitate towards. So it's good to just have a network of people and also like state licensing. I'm not licensed everywhere because I don't do enough business to justify getting a license or a location or a branch or any of those things in every single state. But I have loan officers I've worked with that I can refer that business out to as well. So we all have little niches. You see it on the real estate side too. There's some that are residential real estate agents, and then there's some that are commercial real estate agents. So it all differs and changes based on kind of the niche they want to fall into. I got a phone call coming in here. Oh, okay. Okay, the next question we got here. What is the minimum amount for a FHA loan? I'm guessing maybe minimum amount down, maybe is what they're talking about there, or minimum amount as far as loan amount size. Um, oh, excuse me. Um, the minimum amount is 3.5% down. So on an FHA loan, you take the sales price or appraised value, whichever's less. So in most cases, sales price. You take the sales price and times it by 0.965. That's the most that FHA will loan on. Now you can do second mortgages, you can do down payment assistance programs to make up that difference, but that is the minimum down with at least a certain credit score. There are lenders that will still do FHA loans with lower credit scores and require as much as 10% down. But I would say almost every FHA loan that people are trying to qualify for, the minimum is 3.5% down. There is a loan that is with Fannie and Freddie known as HomePossible or Home Ready that only requires 3% down, but it has different tiers for the mortgage insurance. So a part of my job is to sit down with the client and figure out, okay, which are you a better candidate for? The Home Ready, HomePossible loan or FHA. They all have little niches. They all have little different guidelines on income restrictions. There's things that determine which loan will qualify. That's part of my job is when the client comes in, I can help them know which loan they're going to qualify for, what's going to give them the best rates and terms, all of those sort of things. But that's really the minimum down is 3.5%, 3% on these other programs. Really, the next tier is 5% down. Then after that, it's 10% down. So there's really not like a 7% down or a 6% down. There's really no added benefit once you get past those tiers. So the question there, I'm guessing that's kind of what they're talking about is what's the minimum down payment is 3.5% of the sales price. And if you have any questions, you can throw them in the chat. We can answer those as well. So I just thought I'd jump on here for a few minutes and just answer some mortgage questions. Let's even find another category here. Let's jump into real estate real quick. What is a home loan refinance and how is it useful? So, when you buy a home, you use a purchase loan. A refinance is just replacing that loan with better terms or maybe cash back or consolidating other debts. So, a refinance is just taking your existing terms and bettering them in some way. So, the reason it's useful is if you can refinance to get rid of your mortgage insurance, refinance to pull out maybe additional money to pay off other debts or do remodeling or refinance to get better terms. That's probably the most common reason people refinance is they have mortgage insurance or higher interest rates. Rates are now better, so people refi. And refis have been really slow over the last few years because so many people do have a lower rate than what's available today. But there has been people that bought maybe in the last year or two where it's starting to make a little bit of sense to refinance, if nothing else, just to get rid of mortgage insurance. So let's say you bought a home 2 years ago and you have some sort of sevens, high sixes kind of thing interest rate, but you had mortgage insurance. Now that you've owned the home for 12 months, you can get rid of the mortgage insurance without 20% down. So if you want to know how that works, reach out to me, check out my website at ryanbolton.com, and I can explain some of those programs to get rid of the mortgage insurance, maybe even lower your rate a little bit without having to wait until you have 20% equity. So those are some of the most common ways to refi is usually cash out, reducing the term, get rid of mortgage insurance, maybe even reduce the term. Maybe you had a 30-year fixed and now you want a 20-year or 15-year or something like that. That's not as common, but that is another reason why people refinance. But I would say the most common reason is bettering the interest rate, get rid of mortgage insurance, or cash out for debts or remodeling. You can also add a second mortgage that really isn't a refinance. It's just doing a new loan on top of your existing loan. So that's another thing that people do, but that's kind of the idea for refinancing. Let's see what else we got today. What is the recommended amount to put down on an FHA loan if you have the means to pay more than the minimum requirement? So, if you have the ability to put more money down, you might want to look at conventional loans depending on the other reasons you need an FHA. I'd say FHA is most common for maybe a little lower credit scores because the mortgage insurance is a flat amount. So, you could have a 620 credit score or a 900 credit score, you have the same mortgage insurance. Where with conventional loans, they're tiered, they're risk based. So as soon as you start pushing a 680 credit score, you might be better off to look at a conventional loan, especially if you have the additional requirement down payment. So if you can get to 5% down and you have more than a 700 credit score, the conventional might be a better loan. That doesn't have the upfront mortgage insurance premium. It has potentially cheaper monthly mortgage insurance. So that's kind of the differences there. So most of the time people have more money down, I start looking at other loans than FHA. But there's other reasons for FHA loans, credit scores, job history. There's other reasons, but usually a big reason for FHA is less money down or needing 100% financing, where FHA really fits that very well. And it's not just for first-time home buyers. So first-time home buyers use FHA loans a lot, but it's not a requirement to get an FHA loan or not use an FHA loan is first-time home buyers. It just has some functions in the guidelines that help first-time home buyers. And I would also tell you this, many people don't realize that if you haven't owned a home for the last 3 years, you're considered a first-time home buyer again. So you could have owned 100 homes in your lifetime, but maybe in the last 3 years, for whatever reason, you moved to a new location and you haven't owned a home in the last 3 years, you're now reclassified as a first-time home buyer. So it does open up some of those programs if it makes sense, but so much of that is based on down payment. If you have the money down, there's other loans that can be better. In most cases, they can be better with additional money down. How do I get off of a loan that I co-signed on? So the only way to get your name off that note is to refinance the note. So I know people that will, say, well, hey, I've got this great interest rate. I don't want to lose that interest rate, but I got to take my dad off, my sister, my brother, whoever it might be that's a co-signer. But the reason you got that loan is the people that signed on the loan. The risk at that time needed that co-signer for income, assets, credit scores, whatever it might have been. So the only way the lender's going to relieve that co-signer is going to be a new loan in many cases. Now there might be portfolio loans or in-house lenders that are servicing that loan that will do it. But the note is signed, the terms of that loan are signed to those borrowers. So you can't just remove one. So this happens a lot with divorce situations, unfortunately. You have a husband and a spouse, one of them's awarded the house, but they can't qualify maybe, or they want to qualify, but they don't want to lose that interest rate. Getting a lot more calls on that. But the note is signed with both of those borrowers. You got the loan because of the risk of having two borrowers on there instead of just one. And so you can't, in many, many, many cases, you cannot just remove a cosigner without going through the process of a refinance. Let's see what else we got here. How can first-time home buyers in Texas benefit from FHA mortgage loans? It's FHA is not like a state thing. It's not something where it's only available in certain states. It's a nationwide program, and really the benefit for first-time home buyers is typically less money down, 3.5%. You can have a little lower credit scores. There's other guidelines that can be a little bit more flexible with FHA, and you can team it up with down payment assistance. So the benefit for first-time home buyers for FHA is if you need those types of assistances. If you don't, if you got the scores and the down payment, you don't have to do an FHA loan. But again, part of my job is to sit down with a client, go through their situation, what down payment they have, their credit scores, job history, what they can qualify for, all of those things to say, okay, you're a better candidate for this loan or this one, or a couple different loans. So we narrow down which one they want to do. So, but FHA is very common for first-time home buyers. What is the name of the company that offers FHA loans without requiring PMI? There isn't one. FHA loans are loans that have that insurance. So there's kind of a misnomer when you have a government loan, whether it's FHA or VA, they're just insuring the loan. They're basically insurance companies. They've come up with guidelines that they're comfortable with based on their risk tolerance, and they create the insurance to protect the lender. So when you don't put enough money down, that insurance kicks in. So FHA doesn't actually loan the money. They're insuring the lender that's loaning the money with their guidelines. And so you can't do an FHA loan without mortgage insurance, regardless of the loan to value. You could put 90% down and you still have to have the insurance if you need the FHA loan. But honestly, most people that have the down payment don't need FHA. FHA really fills the gap of people that don't qualify for conventional loans, that don't have the large down payment. That's where FHA is really fitting the niche of what they try to do. And there's benefits, disadvantages both ways, but there isn't an FHA loan that does not have the mortgage insurance. Now, with more money down, it goes away. The percentages change a little bit, but for the most part, it's insurance you have to have on the entire time you have an FHA loan. So it doesn't exist. There's not a company that does an FHA loan that doesn't have FHA mortgage insurance. Good question. Good question. How can I get an insurance amount refund after a home loan is closed? Um, so I'm guessing if that means you sold the property, because even if you've paid off your loan, you still want to keep your homeowner's insurance, obviously. So my guess is this is after the loan is closed, or you've refinanced the loan and you've paid it off, and that old escrow account is now closed. Within 30 days, the lender will refund anything that's in that escrow account. So property taxes, homeowner's insurance, whatever's reserved in that escrow account will be refunded within 30 days. Then the new loan is supposed to then reinstate the insurance and the taxes due from that point forward. So that's usually what happens on the escrow account. Now, if you sold the home and you have some insurance from the year over, that's the insurance company you have. Let's say you're 6 months into that policy, they then would refund you the difference from the insurance company. So you kind of get two refunds: one in the escrow account that's been reserving until the taxes and insurance are due, and then the refund of any premium that's been paid till your next renewal with the insurance company. So there's two things you'd have to do. One will happen automatically. They have 30 days to refund the taxes and insurance out of your escrow account. So they will mail that check. But when it comes to your insurance, you do want to call them and say, hey, I sold the home on February 1st. And they will then say, okay, the insurance stopped on that date. Your renewal is June. We'll refund that difference, kind of thing. So there's two different ways to get the insurance refunded. There's not mortgage insurance refunds or title insurance refunds, just homeowners insurance. There could be some credit back on both the escrow account and the renewal. All right, what else do we got here? I'm going to share this on Facebook real quick. I don't think I did that yet. So let me do that real quick. All right, let's just see if anybody jumps on there. Be very interesting to see if anybody jumps on. Okay. All right, cool. All right, what else we got? Are you are you currently in the process of buying a home? If so, have you noticed higher mortgage rates and home prices? This was posted like 6 hours ago. So really in the last little bit, we've actually seen rates improve slightly. In fact, let me pull up my little how do we end today? Let me look at that real quick. I looked at it right about 2 o'clock, but I didn't look at market close. So we're 1 basis points down today, which is very little. But if I looked at the calendar here, we're now 6 days in a row of improvement until today. So today was the only day it was only down 1 basis points, which is very, very little. And if you go, let's see, we'll go 11 of the 11 last open market days, we've had three bad, and so that's 8 good, 3 bad. So we've been on this trend of little better rates. Not a huge trend. It's not like it's big numbers, but just kind of a nice little trend here of interest rates getting better. We're now back to kind of rates about December 9th or so. They were worse about January 14th. Then we kind of got better, a little worse, and back to better. So there's all kinds of little candlesticks that I watch and trying to figure out kind of up and down where the market trending is so I can be educated on what to tell my clients, like when they should lock, when they should float. And right now we are kind of in the kind of a float pattern right now until we see some market data that's going to switch, but we're just kind of riding the trend recently. So this question I think was just posted like 6 hours ago or so. So definitely seeing home interest rates improve a little bit. They haven't improved enough to where there's a huge change in the rate, but the cost for the rate starting to change a little bit. We're starting to see some rate sheets that are dipping down. I think let's see if I see the national average right now reported is 6.79%, but we're seeing stuff in the 6.5, 6.25 range with some points. You might even get in the upper fives with some points. So we are trending in the better direction. So that's good news recently. As far as home prices, we're seeing them pretty level off, but I'm telling you, the lower price range, there's a lot of people waiting for either a crash or they're waiting for interest rates to get better. And I keep telling people, if there's a house that fits your needs, you need to be shopping for the house right now because especially in that lower price range, if rates do drop, more buyers enter the marketplace. And more buyers are going to enter the marketplace under 400,000 and over. So that section of the housing market is just going to get gobbled up like crazy if rates do get better, which they are predicted to do. So there's been so much talk about better interest rates for almost a year. So everybody just keeps waiting for after the election, waiting for this, waiting for that. And I tell you that the problem is most people I'm talking to that are waiting in the lower price ranges. And all of a sudden, if we do get 5.5% or something like that, and all of a sudden 100,000 more people enter the marketplace, the competition is going to go way up. So instead of competing against one or two people on that home, now you're going to be competing against 10. Then the one that's going to get it is going to be offer more price. So I think there's going to be a lot more pressure to move prices up, especially in that lower price range. Now, does that mean that the higher end's not going to see some more fluctuation? It always does. But if you're in that lower price range, first time home buyer, kind of that lower range, you need to start shopping now. Get pre-approved now. Get ready when the home hits the market, jump on the house. You can always change the rate. If rates do get better, you can always refi. You'll want to refi after you get rid of mortgage insurance anyway. Most people keep the loan 2 to 3 years kind of thing, maybe less if they have mortgage insurance. So you're not marrying the rate. We have a saying in the industry, you date the rate, you marry the house. So find the house that fits, get into it sooner. You won't regret it. You won't regret getting into a home because of some crash you think is going to happen or some massive reduction in interest rates. You can get ahead of that curve. This is a chance to be able to buy low kind of thing on the price. And if rates get better, you now can take advantage of the lower payment, but you won't be able to take advantage of the lower price because we still have a massive inventory issue. We have a massive affordability issue, especially in the lower price ranges, because they just can't even build them at that price range. So when it hits the market, you want to jump on it. You really do. And it's amazing on a 30-year fix, the 0.25% different in rate doesn't make a huge difference in the payment. Now, over the entire life of the loan, yes. But over the short term, that monthly payment is not going to be that big. And if it does get better on rates, you can always do a refinance. So I recommend start shopping, get pre-approved, get ready. If the home hits the market, jump on the home. All right, how we doing on time here? Where's my timer? My camera's kind of right in the way. All right, we'll go for a few more minutes here. Then we'll go to 7 o'clock my time. Excuse me. Let's see. How do conventional loan limits impact buyers? Well, conventional loans are typically better interest rates and maybe different down payment requirements. So anything that's above that, you either have to put more money down to get under that number, or you have to pay a higher rate above that number. So the conventional loan limits have always been something where builders and certain markets try to be kind of right above that or below that kind of thing. They're aware of that number because it does open up financing options, which means there's more buyers for that particular home. So as limits change, the loan limits change, that gives more conventional money, which is cheaper interest rates typically, and allows for more buyers to enter the market by having a little higher loan amount. But the loan amounts don't change like dramatically, but they have been going up steadily based on median home prices, based on the home price of homes. There's even some areas that are known as high cost areas that go above the conforming loan limits. So they all get announced. It's funny. I know every Christmas, every Thanksgiving, they announce kind of the loan limits for the coming year. And we always see all kinds of Facebook posts and lenders get all excited because they can start doing those loans a little bit early because they can kind of hold it on their books until the new loan limits, the new higher loan limits kick in, and then sell those loans at the first of the year. But it's funny how often that we always there's funny memes all over that just show, hey, the loan limits are coming, the loan limits are coming, because there's all kinds of advertisements about those loan limits. But that's really how it affects home buyers, is and when you're under that conforming loan limit, you're typically getting access to cheaper interest rates. And so that's why people try to loan under that amount. They're right on that edge. Now, if you're in the millions, if you're doing $1 million, $2 million house, it doesn't matter. But when you're in that range, it does make a difference on the interest rate. How are we doing on time? Check, make sure I don't. Okay. Let's see what else we got here. I was thinking of taking a home loan out. Which one should I take? Floating interest or fixed? Oh, interesting. Okay. So floating when I hear floating, that's not locking in your interest rate, but I'm guessing it's an adjustable rate versus fixed. There's benefits and disadvantages with both loans. Typically, adjustable rate mortgages have a cheaper start rate, knowing that you're either going to have to refinance within a certain time frame, so they're not going to have that loan out forever, or you're going to sell or do something to that loan in a shorter period of time. Now, the market doesn't even really care that much for ARMs because of the regulations, and it just isn't a hot. They don't sell a lot of them. They used to sell a lot more of these ARMs, adjustable rate mortgages. They've kind of ticked up a little bit in the last few years, but it's really, if you're not going to keep the home for more than 5 years, if you're confident with the interest rates going down, which many people are, the adjustable rate can give you kind of an introductory rate for 3 or 5 or even 7 years, and then you have to sell or refinance before the end of that. And you don't necessarily have to, I should say, but the rate most likely is designed to go up after that 5 to 7 years. And typically it can't go down because I'll have floors and ceilings. There's all kinds of stuff that makes it a little bit more complicated. But the idea is, if you're not going to keep the home, if you know it's only a 3-year loan because of a contract with work, or you're going to be graduating, or you're going to have kids, or you're going to retire, there's going to be something where you just know you're not keeping the home for just 30 years or even 10 years. That's where these ARMs can be helpful. But there's not as big of a difference between a 30-year fixed and some of these ARMs anyway. So almost everybody just opts for the 30-year fixed. But I think they're going to get more popular. I think there's a niche for them that does make sense for the right borrower. As long as you're educated on how it works, when it adjusts, how much it'll adjust, that's what determines to make sure that your eyes are wide open going into that. All right, let's see. That's a good question. Don't run across a lot of ARMs. Very rarely do you have somebody say, ARM rates, or, what's your 5? They used to call them 5-1 ARMs. So it's fixed for 5 years, then adjust once a year after that. Those were a lot more popular maybe 10 years ago, maybe. I mean, maybe even longer at this point, but they're just not as beneficial because the rate differences aren't as much as they used to be. Even with like a 30-year and a 15-year term isn't as much of a gap as it used to be either. So just 30-year fixed has got to just, I'll have to look at the numbers. It's got to be 90%, 80% of all mortgages, if you count conventional loans, have got to be a 30-year fixed. But anyway, All right, let's see if we can find another fun section here. If you have any questions, you can post it in the chat. Is it possible to exit an FHA loan without incurring penalties? There is no prepayment penalty on an FHA loan. So when they're saying exiting, I don't know if that means before the loan closes or after, but no, there's no fee to close out an FHA loan, especially past the 6-month mark. So once you own any loan, any mortgage, every lender that we do loans with, if the loan pays off before 6 months, we have to pay back discount and fees and all that type of stuff because lenders are not in the business of doing short-term loans. That's not what the loans are for. The way that the time it takes, the title insurance, all the stuff that goes into it, they want the loans to be out for at least 6 months. Now, it's not in the note, it's not built in, but every lender, myself included, will have what's called a recapture fee or clawback. There's a couple different terms out there. Early payoff, EPO, is another word that we use. But essentially, this is where the borrower sells the property or refinances within 6 months of ownership. We then have to pay back all the fees. So I always tell my clients, you got to keep at least 6 months. If you're not going to keep it 6 months or plan not to, we need to just do it as a different type of loan. And so that's a conversation I have with a lot of my clients. But once you get past 6 months, there's really no penalty. And there's really not an FHA penalty. FHA is not going to charge a penalty. But it's funny, if you do an FHA loan, you paid upfront mortgage insurance, you've been paying mortgage insurance, you paid all the fees, all that kind of stuff. Paying it off really early is silly in a sense because you paid so much for the loan. So if you are able to pay it off that much sooner, there's different loans we can do that don't need to use the FHA option. So that's kind of there isn't a penalty necessarily, but there is something where we need to keep the loan for at least 6 months. Oh, I'm gonna sneeze. Okay, let's see what else we got. And if you have any questions, you can post them in the chat. I hope I got the chat on. Don't even know. So, oh well, we'll find out. Is it possible to do a cash out refi without refinancing the entire loan? No. So you can do a second mortgage or some other loan that's on top of the first mortgage, but you cannot just refinance part of the loan because the refinance is getting rid of that existing loan. It's replacing it with a new loan because of the lien position, the loan amount, the term. So if you're trying to pull cash out of the property, you have to do it with either a new loan on top of the first mortgage or refinance the first and increase the loan amount. The reason there's benefits both ways is typically the rate on a cash out refi is a 30-year fixed. And so you don't have like a HELOC or a line of credit that can adjust. But there's hits for the rate whenever you do a cash out refi versus a purchase or a rate and term where you're just taking the existing term, lowering the rate, getting rid of the mortgage insurance, something like that. But the short answer is no. You can't just like say it's a $300,000 loan. You just want to pay off 200,000 of it so you keep the old interest rate and add to it. No, that once that to get rid of that loan or to refinance the first, the whole thing needs to be paid off. Just like if you were going to sell the home. If you're going to sell the home, you can't just like not pay off the loan to sell the house. You would have to get rid of the entire loan as part of selling the property. So short answer is no. All right, what else we got? A lot of FHA questions on here. Am I on a FHA tab? Nope, just regular. A lot of FHA questions. Interesting. What is an FHA loan and how different is it from a usual loan we use to get a house? So, FHA just has different guidelines. You have conventional loans, you have these loans called non QM, which is qualified mortgage. You have conventional, which is Fannie Freddie. You've got private loans. There's all kinds of different loans, and all of them have a plus or a minus or a benefit or a disadvantage depending on what the client needs. So, FHA is just one other way, not the only way, not even necessarily the best way for everybody. It's the best way for certain people. Absolutely. That's why that loan program exists. That's why conventional loans have guidelines that they do. That's why second mortgages exist. That's why private money, construction loans, reverse mortgages, all of them have a need or a niche in the marketplace that they're trying to solve. And FHA is just one more home loan that has different guidelines, different quirks that help you into buying a home. And again, part of my job is to sit down with the client, see what their needs are, see what their qualifications are, and figure out which of these loans is the best fit for what they're trying to do. And it can be an FHA loan. Sometimes it's something different, but we have access to a lot of those different tools. In fact, I often joke that I sell money for a living for real estate. That's really what I do is I sell the money that is used to buy real estate. And my job is to find the best money source for each individual client. So, yeah. Is it easier to get approved for a mortgage with a mortgage broker? No, not necessarily, because the guidelines are very similar. Like FHA, they set the guidelines, not the company you're working for, not the loan officer. The guidelines are set by Fannie, Freddie, FHA, jumbo loan, whatever it might be. So it may not, the only difference is with mortgage brokers, they may have access to more programs, which maybe I'll say yes a little bit more often. That's really probably the biggest reason for a mortgage broker is just access to more products. But if you're FHA and that's the only loan you qualify for, it won't matter if you use a broker or somebody else. If it's a jumbo loan or a construction loan or reverse mortgage, some of them are just kind of are what they are. And we all get the guidelines from the same places. We all get the money from the same places. You might see fees be a little bit different based on compensation or commissions or that type of thing, may be a little bit different, or maybe processing and underwriting fees might be slightly different. But really, that's not what separates us as much as just product availability, answering the phone, being accessible, having more ways to say yes to more clients. That's really what separates us in the mortgage business is those things, not so much approval or different types of loans as far as guidelines. Because if you're doing an FHA loan, you're following their guidelines. It's not like all of a sudden that somebody else can do an FHA loan that I can't do. I mean, it's just not, that's just that program. It's how that program works. What are the benefits of paying off a car loan before refinancing? The only benefit there might be the debt ratio. By not having the car payment, now you have a different debt ratio. So then you can qualify for more. But if it's a refinance, that's probably the only benefit. Doesn't really help the credit all that much because when you pay it off, it takes a few months for it to update and report anyway. And really, that's probably the only benefit is debt ratio. But I'll tell you this, if your debt ratio is okay, paying off the car doesn't really help, but now you don't have the money in savings. You don't have the money in your checking account or wherever that money is to pay off the car. Now you don't have that as reserves, and that's also important on the loan. So it's not like it's one thing. There's like boxes that we look at. And if you're weak in one box, we can use another box to kind of offset, but we can't just ignore completely these boxes. Credit score is one of them, loan to value, time on the job, debt ratio, all these are factors. And money in the bank can be an offsetting risk to debt ratio or reserves. Or so I've had times where people will get rid of all their debt and they have nothing in savings, and we still can't do a loan for them because they have nothing in savings or reserves. So it's important before you do those types of things to talk with your loan officer, talk with me. Let's look at the whole thing to make it easier on yourself, and that you don't just do something you assumed was going to help and then cost you either interest rate or time or approval or something like that. I'm amazed at how many people think that they're helping themselves and actually shoot themselves in the foot, especially when it comes to paying off debt versus having that money in their account. Now, you can pay the car afterwards, sure. After the loan's done, all that kind of stuff. If you just have the money and you just don't want the car payment and trying to get out of debt, then pay off the car. But I've had a lot of times where people will pay off debt thinking that's going to help and actually can backfire. So it's important if you're thinking about buying, thinking about refinancing, get with an expert, get with somebody like me and let us help you with that process. So that way you're getting easier paperwork, easier pre-approval, you're getting better rates and terms, all of that stuff when you start working with us a little bit earlier. We're on your team. We want to help you with this stuff. We know what we're doing. So let us help you with this stuff. It'll go so much smoother. All right, let's see if we can find another one. This has been fun tonight. I love this stuff. I love nerding out on the mortgage industry and answering questions. I just have fun doing this. That's why I'm still in the business. It's been pretty rough last couple of years. '08 was really tough. I went through that, but I like helping people with home financing. I just think it's fun. All right, let's go. How are we doing on time? Well, we can keep going. We're having too much fun. We're having too much fun on a Thursday or whenever you're watching this. Oh, let's see. Is it beneficial to pay off a home loan early if you have enough money in reserves and it won't affect your eligibility for a future VA loan? Oh, that adds a little interesting twist. If you watched any of my channel, if you've heard me talk at all, I just think there's so many more places to put your money when you can leverage it with mortgage loans, you can get better financing, 30-year fixed rate money, locked in payments, than tying up all your money into real estate that you can't get the money back without selling or refinancing. So It is very case by case. I'll sit down with clients that have plenty of money, they can pay off the house, not have the interest, not have the debt. Totally makes sense. But so many times I see people put these huge down payments down, and 2 years later they need money and they can't get to it. They lose their job, they have health issues, something happens, and now all of a sudden they have all this equity they can't even get to. They can't get a loan, they can't qualify for a loan, or rates are worse, or whatever it might be. Where it's like, wow, if we would have just structured it in a way where you kept some money down and some in saving, kind of diversified that money, you'll be a lot safer. Like, you wouldn't take all the money and put it into one stock or one gold bar, but we put it all into one piece of real estate. You can go buy two of them, go buy three of them. Take the money and put it in index funds and gold or cash or crypto, or you can diversify it so many more ways when you have access to it. Where if you just bury it all in the house, yeah, you don't have a mortgage payment, but a mortgage payment's a lower payment, a better interest rate than any other type of debt out there. You got tax benefits potentially. There's so many more ways to leverage with that if you have ways to look at it. And that's part of my job, is just sit down with clients and say, okay, what makes the most sense? Maybe open their eyes up to different payment options. If you have any other debt, get rid of all the other debt first before the home loan. There's just other ways to put it. So I've got real estate, I got rental properties, I got a lot of different things I do with real estate, and I try to leverage where I can along with cash flowing to be able to make this work instead of just owning one house free and clear. Well, great. But now I have to get a loan to get access to the money. I have to sell the property to get access to the money versus just already having it, buying other real estate or in index funds or wherever else I'm trying to diversify the money with. So I think there's just better places to put the money. Let's see how we doing on 10. Let's see. Is it possible to be approved for a home equity line of credit if you're not on the deed? No, you have to be on the deed to be able to loan. Otherwise, you're not an owner of the property, but you can be added as part of that process. But the short answer, no. It's like getting a loan on a home you don't own. You have to own it. That's being on the deed means you own the home. So you're one of the buyers or one of the owners, I should say. So no, it's not possible to get a home equity line if you're not on the deed, but you can be added on the deed as part of getting the home loan. So it can be part of the process of getting the home equity line of credit, but not ahead of time. It's part of the documents you'll sign is to be added to the deed, but the owners also have to agree to that. So the spouse or the cousin, or whoever you're doing the home equity loan. Otherwise, you could do, if you didn't need to be on the deed, you could go get a home equity line of credit on anybody's house you wanted to. You just go down the street and said, I want a loan on that guy's house. So so the answer is no. You have to be on the deed to get it, but you can get put on the deed as part of getting the loan. Oh, that'd be funny. So I want a loan on the Delta Center. I don't own it, but there's a lot of equity in that thing. That'd be great. All right. Is there any negative impact on your FICO score when getting approved for a FHA loan? No. So the type of loan you're getting with the inquiry doesn't matter. The inquiry is saying you applied for a mortgage loan. They don't know even what type of loan you got until it actually starts to report, and it doesn't affect your credit, the type of mortgage loan that you got. So lines of credit, home equity lines of credit, revolving accounts, some certain accounts do get measured differently with the credit bureaus, but that's well after you actually got the loan. So the credit score or the impact to your FICO score is not based on an FHA loan versus say a conventional loan or a VA loan or a USDA loan or whatever it might be. So no, it doesn't have an effect on that. I don't know what else they could think. Yes. Is there any negative impact on the FICO score? No. Nope. Because there is the hit for the inquiry itself, but the type of loan you're getting is not even part of the credit pull. The credit pull is just somebody applying for credit so we can see their history, lates, collection, judgments, charge-offs, bankruptcy, whatever's on their credit history, and what their score is with the scoring model, but doesn't know you're getting an FHA loan. It knows you're applying for a mortgage loan, but it doesn't know the type of mortgage loan, if that makes sense. Let's see. What is the difference in interest rates for VA loans compared to other types of loans? VA loans are the best loan on the planet. Period. They have no mortgage insurance. You can get rid of the funding fee potentially depending on your disability. You can get 100% financing. Rates are usually better than almost anything else is out there on any given day. So if you can qualify for a VA loan and you need 100% financing or high loan to value, I mean, there might be a benefit if you have the money down not to do a VA loan, but generally the rates on that are really good. There's no monthly mortgage insurance, regardless of how much you put down, even 0% down, still no mortgage insurance. So it is really one of the better loans on the planet, if not the best loan on the planet. So, but typically on any given day, it is a better interest rate than conventional and other loan programs, is the VA loan. What will happen if I'm unable to pay my mortgage loan after 4 years? Well, if you're not able to pay, they take back the collateral. So the collateral for the loan is the home. And in 4 years, if you can't make the payment anymore for job, or I'm not sure why they know 4 years, maybe retirement, or maybe something where they're worried about not being able to make their payment after 4 years. But that's where they take the collateral back. So if you have a mortgage payment, you can't make that payment anymore. They start the process to take the property back so they can then sell it to get their money back by selling the property, by becoming the owner of that home. And I have people all the time, so I just rent it from the mortgage company. That can't be further from the truth. Just just because you have a loan on, you have to make a payment to keep the property doesn't mean they own your home. That's just the collateral for the loan. Just like the mortgage company can't show up and say, "Hey, I want to use your house for the weekend. I'm owning it. You're just renting it from me," or something like that. It's just the collateral for the loan. But if you don't pay your payment, then they start the process to take back the collateral. But they're not the owner of the home. They're not on title as an owner, none of that stuff. So it is an interesting, I mean, in a weird way, yeah, you're renting it from the bank because they can take it away, but they're not an owner. You are the owner of the home. You can sell it. You don't have to go to the lender and say, "Hey, I want to sell this home. Will you allow me to sell it?" No, you pay off the loan. You can do whatever you want with it. You can change the color of the walls. You can have pets. You can do remodeling. It's your home. It's your home. It's just collateral for the loan. So if you can't make your payment after 4 years or 2 years or 1 year, doesn't matter when, if you can't start making the payments because of job loss, health, that's where you run the risk of losing that home in foreclosure. What does 20% down mean for a 30-year fixed rate mortgage? So that will be typically a little better interest rates because you're putting more money down. But honestly, what I've seen is that 20% down, the rates aren't that much better because with 10% down, they have mortgage insurance. So it actually offsets the risk. And so you actually see some better rates sometimes with less money down, but you see a higher payment. So there's a combination of what's the best payment for a borrower versus best interest rates or best loans, and there are differences. But 20% down usually means a little better interest rates, no mortgage insurance. That's probably the biggest difference. But really, the better rates start kicking in at like 25% down or less money down, but then you add the mortgage insurance. So, but that's the most common reason for 20% down is you don't have to add that additional mortgage insurance premiums or things like that on top of the interest rate. So that's where 20% down comes from. But you don't need 20% down to buy a home. You can put down 0% and still get a home, but there's benefits and tiers based on that down payment. And a lot of times I have people that show up that have a very little down payment. I'm like, you're better off to keep that money in the bank for savings, emergency, moving expenses. Maybe when you move in, you've got to remodel or you've got to buy some stuff for the new house, maybe new furniture. You just have to have some money on top of just down payment. And taking everything you got to get in the home may not be better than just doing 100% financing. It's not a huge difference in the payment, and there's a lot of programs that kick in for 100% financing. So it may not always be the best option to put money down. And that's part of my job. Sit down with a client and say, okay, this is taking your 10 or 15 grand, taking all of your savings. You have nothing left over for rainy day, emergency, car breakdowns, sickness at work, whatever it might be. Or we just have your payment 20 bucks more, 30 bucks more a month, and you keep that 10 grand in your bank. Almost every time it's like, oh no, I'd rather have the money. I'd rather keep the savings or get rid of some other debt. Maybe they've got a car loan or something that's a couple $100s a month. We'll get rid of that instead of putting it down on the house. So it's important to know what other options are out there and how they compare. All right, let's see. We're at about 50 minutes. Let's maybe go let's do two more. We're gonna do two more. We're not gonna get on a soapbox. We should do like a rapid fire, right? Just go yes, no, yes, no, yes, no. I don't know if I can. So I try to make sure I explain the whys behind some of these questions, but let's try it for one. We got some time here. Let's have a little fun here. Okay, let's go. Let's go back into just mortgages, and we're just going to see yes, no, yes, no, yes, no for a second. Okay. I want to file Chapter 7 bankruptcy to wipe out my $200,000 mortgage. Can I keep the house? Can I do that? Maybe. I can't even do yes or no on that one. So it depends on the equity of the home. It depends on if the Chapter 7 will require that you sell the house. In many cases, yes, you can keep the house. Um, you can reaffirm the debt, or that can be something, but that's that's too nuanced of a question. It depends on how much you owe versus what it's worth. Depends on the other debts. And the Chapter 7 means that you're vacating all your assets and they're going to take all your assets and pay it off all to your stuff. But if you owe too much on a car or house, they don't worry about it because there's no real equity there. But if you got equity in it, then the Chapter 7 is going to take the home to be able to pay off your debts. If it's Chapter 13 where it's restructuring and you're making payments, that's where you typically can keep the loan or keep the home. But in a Chapter 7, depending on what it's worth, they can take the asset to pay the debts. And so, but they can also, there's rules with that, but I would say maybe. I can't say yes or no. All right, let's see the next one. What are the potential savings of using an FHA loan? Well, it's not a yes or no question. So VA is cheaper at because it doesn't have mortgage insurance and typically lower interest rates. So you can get a little more buying power, 100% financing, lower fees. So it is a really good loan on savings because it can be a cheaper loan for the same amount financed. All right. What ugh, does the amount of money you have in the bank help to qualify you for a mortgage? Yes. Aha. Yes or no? Yes. We're going to see how many we can do just yes or no here for the last 5 minutes. What are the potential consequences of having multiple mortgages when purchasing another house? Debt ratio issues. By having multiple mortgages, now you have to qualify for multiple mortgages, which means the debt ratio is where you run into the biggest issue. Also, if you have too many financed homes, certain lenders start not lending money. Like Fannie and Freddie have guidelines for the first 1 to 4 financed homes, then I think it's 4 to 6, 4 to 8, and then to 10. Then they don't typically finance somebody that has more than 10 financed properties. So they have rules when you get too many mortgages on financed properties. But the biggest consequence typically is debt ratio. So if you have multiple mortgages, usually you have multiple rentals, which is offsetting that mortgage payment. But debt ratio, you still have to qualify, jump through hoops, tax returns, that type of thing. Okay, not a yes or no question. All right, we got to find yes or no ones. Can I just give my house back to the bank? Yes. If somebody accidentally, that's not a yes or no. If somebody accidentally paid their mortgage twice, would they get their money back from the bank? Typically, no. So if you paid it twice, it doesn't really pay the next payment. Like car loans, sometimes if you make a double payment, you're just kind of accelerating when you're going to pay off the car. With homes, when you make the payment as instructed in the note, it first goes to interest and then escrow account and then principal. So if you've already paid the interest, if you make another payment, all of it goes to principal. It doesn't typically go to like making your next month's payment. Now, if there's a gap between the two, sometimes a lender will allow it to kind of pay the next month's, but then it goes right to principal. But almost every mortgage, if you pay anything extra, including accidentally paying a double payment, all of that goes directly to the principal of the loan. So you want to check with your lender and see if they will allow it to just count towards your next payment. But almost every single time, the payment's still due next month. You've just now put a bunch of extra money to the principal. So you will pay off the house faster, but I have seen people, oops, I double paid, double bill paid, or an automatic payment, and I still paid it. I have seen that happen, and almost every single time it goes right to the principal. Should I pay off my car loan or my house mortgage? Car loan. Aha. Am I considered a first time home buyer if I'm not on the mortgage? Not necessarily. If you're on the title, you're still an owner of the home. But if you're not on the mortgage, you're likely not on the title. So you could be. So that the answer on that could be. It's not just about the mortgage, but if you're on the mortgage, you're most likely on the title. But if you're not on the mortgage, but you are on the title of the property, then you're not a first time home buyer. Also, again, I think we talked about earlier on, but if you haven't owned a home in the last 3 years, you're back to a first time home buyer. So, again, even if you've owned 100 homes or 1,000 homes over your entire lifetime, if you haven't owned a home in the last 3 years, you're now reclassified as a first time home buyer. I sold my home and closed on the sale on the 27th. Will the mortgage payoff be received before the next month's payment is due? Most likely, yes, because they usually will wire the funds to make sure that they show proof that the wire was done, the confirmation, that type of stuff. They very rarely will just throw a $300,000 check in the mail and just wait for it to go to the lender. So I would say maybe a title company would answer that, but I don't know a single title company that doesn't wire the payoff if you sold a home. So it should be received within that day or the very next day. especially as you get closer to the end of the month. They might overnight the check if it's certain times of the month, but even then, there's the overnight fees and all that kind of stuff. They're not just going to throw a check in the mail, not for that amount. So usually there's good funds, a wire, something like that. So I would say you're good, but it's definitely worth making sure. Check with the title company. How do they pay off that loan? Just so you don't end up getting a 30-day late on your credit because the payment didn't get there to pay off the loan. That's what you'll see. Sellers will, well, I'm paying off the loan, so I'm not worried about the payment this month. That's just included in the payoff. Gets closer and closer to the end of the month, and all of a sudden, bam, they get some 30-day late because they didn't pay their payment that month. So the good advice is just pay the payment. The interest is accruing either way. Just make your payment. Then your payoff's just that much less. So if you can, just make the payment. But in most cases, I can't think of a case where they wouldn't wire it or even overnight it or something like that, that the good funds. So it should be good. But check with the title company to just get confirmation. Yep, they got the wire. They're paid. They're good. Your loan's paid off. And then just maybe it's not updated on the website or they haven't updated it. But just get confirmation from the title company they did wire those funds. All right, how are we doing on time? Where's my clock? I'm gonna try about an hour. We got 5 minutes. Let's try to do some yes and no, just yes and no's for a second. Here we go. Ugh. I can't. My son asked me to co-sign on his mortgage loan. Should I do it? Maybe. Realize that co-signing, you are obligated on that loan and you can't get off of it till you sell or refinance the home. So it depends on your relationship with the kid, the long-term goals, how long you need to be on it, why do you need to co-sign, and will that change over the next couple of years? But realize you can't just unsign your name off that loan until you refinance it. You're on that loan. If he misses a payment, it affects your credit. The reason he's getting that mortgage is you helping to co-sign. But at the same time, you're helping him get that mortgage, helping him into real estate instead of renting. There's a lot of benefits with it, but just go into it with your eyes wide open of what happens if he misses a payment. What happens if you sell the home? What do you split as far as equity? You want to think these things through to make sure you're going into it eyes wide open and you discuss everything, because the last thing you want to do is lose a relationship with your father or your son, your mother, whatever it is, because you mixed business and family. So many things have blown up families when it comes to money and these types of things because you just didn't talk about what happens when things go wrong, because that's what's going to affect the family. When things go right, no problem. But all of a sudden, if he misses a payment, then you have to kick him out. You have to force him out, or you have to start making the payment for him. It gets ugly. It gets really ugly. So a lot of people might say lean towards the no side of that answer. When I lean towards still maybe, it depends. It really depends on the relationship, getting everything in writing, make sure it's clear as business as usual possible documentation, and just say, okay, if you don't make the payment, we sell this house. If you don't make the payment, you have to move out. If you don't make the payment, I need to know about it, or I need to be notified if you haven't made the payment if something goes wrong. And we need a strategy of when you're going to be able to refinance this. And if you're the dad and you want to buy a house or you want to do something, your credit's tied up on your son's mortgage. So you want to make sure you're also set up to where you can handle that debt if you need to. So the answer is maybe. The answer really is maybe. All right. How are we doing? Sorry, my little camera is like blocking everything. Such a small little camera and it's blocking so much. All right. If you make more principal payments on your mortgage loan, will your loan amount decrease? Yes. Of course. Where else would the money go? If you pay extra money, you pay the interest. Yeah, the rest goes towards decreasing the balance. You're increasing the amount going to principal instead of interest. So once you cover the interest, everything else is going to principal. So that's why people round up their payments, do biweeklies, do other things to be able to just kind of get more going to principal, which means you'll pay less interest over time. So yes, if you make additional principal payments, you'll owe less on the balance. After taking a home loan, do you feel it's a good or bad decision? It's great. Oh, we're just, yeah, you know what? We're just about to hit the 1 hour mark. So I appreciate anybody that watches this now or afterwards. If you have any questions, I'd love to answer any questions you might have. And I'd love to just help you with this real estate financing, this mortgage world. That's what I do for a living and really enjoy doing it. I do lending in the states of Utah and Nevada. You can check out my website at ryanbolton.com. And we have a cool little mortgage app that we just developed that I'm getting on the site. I've got some really great mortgage calculators on my website. So if you just want to play with some numbers, got some really cool calculators on there that I got from a third party that kind of embedded in my website. And I think they're great. They really are useful because they don't just do the payment on the loan. They'll break down tax insurance, mortgage insurance, different types of loans. They're just really cool calculators on my website. So check out ryanbolton.com. If you have any questions, you can give me a call. If you want to get pre-approved, home equity line of credit, if you're trying to buy or sell or refinance, whatever it might be, I'd love to be your loan officer and love to help you with this whole process, especially in Utah and Nevada. So check out my website at ryanbolton.com. My license number is 299717. I have to make sure I put that on the video as well for lending laws and things like that. But love an opportunity to work with you. ryanbolton.com, and we'll see you on the next video.